the importance of our business comes down to trust. Meaning when they come to me, it's this trust that they have in me that I'm going to do the right things, regardless of what parts of it they understand and they don't understand.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, I'm Kevin Jamali, Senior Vice President at Farther, and we're here to talk about merging modern technology and investment advice on The Derivative.
Welcome, everybody. Hey, Kevin, how are you?
Doing good, Jeff. Thanks for having
Good.
me on the show.
Yeah. Where are you? At home?
I'm currently at home, yes.
You miss the city? Kevin and I have known each other for a long time. He used to be a city guy like me and went to the dark side, as we called it, and moved to the suburbs. But has it all been good?
It's all been good. I mean, I was born and raised in the city, and the thought of moving to the suburbs was like a death sentence to me.
Yeah.
So, when my wife was pregnant with the first child, she had to kind of pull me, and I was kicking and screaming. But to be honest with you, now that I've been here, I've been sort of domesticated, and now the thought of living in a tiny apartment in the city doesn't appeal to me as much. So.
You can be in a house in the city, but
You
yeah.
could be in a house in a city, yes, that is true. But just the peace and quiet. Sometimes I catch myself when I come downtown, like, oh my God, it's like so chaotic here, and
Mm.
I have to slap myself. I'm like, what happened to you?
Jeff Eisenberg, who you know in our office, and he moved to Ohio. He comes for meetings sometimes, and he's standing on the corner. He's like, there's more people right here in my view than I've seen in the last 3 months in sleepy Ohio. I'm like, all right.
Yeah, Jeff lives on a farm, so for him,
Yeah.
yeah, that is a bit of a stretch.
Well, thanks for coming on. Wanted to get your thoughts. You've kind of come at the industry from a different way. We always have these guys who start in the stock world and kind of move into alternatives.
Mhm.
And correct me if I'm wrong here, but it seems like you kind of started in the alts world, futures especially, and then kind of moved into not the stock world, but sort of the stock world. So kind of want to dig into that. It's kind of a reverse path that seems interesting. I think the listeners would like. So start us off where you started here in Chicago, and we'll go from there.
Sure. So I started my career at the Chicago Board of Trade way back in the day, and my primary focus at the time was trading the yield curve. And then later on off the floor, I was trading the basis trade between the cash and futures. But and actually, without I'm a bit of a dinosaur of the industry. I think I was one of the first people that started electronic trading. The old Project Day overnight. I don't know if you remember that or
I
not.
do, yeah.
Yeah, so I was one of the guys that be up all night, and so then eventually, obviously, as we all know, what happened.
Were
But
you ever in a physical pit, or you just went straight into the overnight?
no, so after trading Project Day, I was in a 5-year pit.
Got it.
So initially, it started out by sort of flashing the orders into the 10-year pit or the bond pit, and then it was like the headsets, and then towards the end of it, we had the handheld devices where we're able to put one of the trades in. I remember like once again, I was like one of the first ones with the device, and yeah, and then it just
Where
took off.
guys like, what the hell's out there? Yeah.
Yeah, either that or the guys are like, I want to kill that guy because he's gonna right. It was more of that, but my whole thing was it's inevitable. So you have two choices. You could either fight it or roll with it. And it was just a matter of time before everybody realized that, they have to either adopt it or move out of the way.
Yeah,
So
what was the split originally? Like 50-50 or not even of people who were gonna fight it or adopt it?
no, there's a big push. I mean, initially it was like, 99, 100%, like nobody wanted it because we
Yeah.
sort of knew what that meant. But if, once people started adopting it, it slowly grew. So like it was like me and maybe a few other people, and then slowly more and more people just by force, even though they didn't like it, like I need to either have this device or not. And back in the beginning, I mean, it was insane. Sometimes like some of these orders were just all over the place, where you could theoretically get some deep edges on the screen. It was a liquid, they're trying to, I don't know who the market makers were back then, but yeah, so there were some good opportunities in that sense. And then, you have some really crazy things that happen. I never forget 9/11, for instance. I mean, I literally went from like being blown up, multiple numbers above what my account had to, eventually and not getting hurt by just a split-second decision of covering a position. Because right when all that stuff happened, I remember like on the screen, like let's say the market was like offered at 20 and I saw like a bid for like 30 bid or like,
Mm.
O2 bid, like the next price over, which is a
Yeah.
huge gap for, those who understand the futures. And we're talking about the 5-year market, by the way. It wasn't the bond tick size.
Yeah.
And obviously I clicked on it and sold it. I'm like, this is the mother of all edges. But something within me at that second, and it was just because we had nobody knew what was going on, and I covered it, even though like I covered it like it was a profit. I just lifted all the offers,
Yeah.
and then the next thing I know, Jeff, like let's say if I sold O2s, a guy jumps up like 5 bid, 10 bid, 20. I mean and I was like literally physically shaking. And it was in the beginning, so I had to call in the middle of the thing. I was calling the help desk for at that time it wasn't Project A. At that time I forget whatever it was called, like the Board of Trade.
So
And I'm
like for
like,
the actual tech, like, hey, are these real?
I said, did I cover, like, yes, did I, what's going on? Is this trade real? And they're like, yes. I'm like, are you sure? Are you sure? And then I bought some of it on the screen too, because it was like a bid and then it was like an offer. So I was just like, making sure that I was flat in that insanity. So yeah, there's some crazy stuff that
Which is
happened.
great. I think people think that 2011, right, wasn't that far back. 2001, right?
2001,
Sorry,
right?
9/11 and 2001, not that far back. But those were early days, right? I
Right,
explained to people like if you had gone on the floor and seen the paper, right? They're like 6 inches of paper on the floor every single day. Like just to save the
right,
planet, save all that paper every day made electronic make sense. And then you had some hungover kid like me at 6 a.m. meeting other hungover kids to figure out the out trades. I'm like, that wasn't a good system either.
right.
So it was begging for electronic. It needed it.
Yeah, right. And
But
yeah.
yeah, it's sad to me. Like, where does that next layer of me and yous come from that get into the industry via the floor, right? That's what I think is going to be missing in 20 years.
Right. Absolutely.
So then
So then
from
eventually
there,
from that I transitioned and I was managing a CTA strategy for 10 years. Where we were trading, it was a completely different approach. Instead of like focusing on a few markets, we're trading roughly 80 markets, that's including the spread markets. It was 100% systematic, quantitatively driven, and which was a complete different transition from what I was used to, right? So I did that for 10 years and then eventually transitioned into the role I'm in today, which is, I predominantly, the focus of my focus within the team is investment management and the use of alternative investments, the proper use of true alternative investments.
expand on the CTA a little bit. Do you miss those days? Like, let's put the three career. So there's the futures trader, the CTA, right? You're trading your own money, or were you just clerk? You're trading your own money.
Yeah, so initially I was backed,
Yeah.
but then, later on it was my own money. Yes. Yeah.
So it was like trading your own money, futures, trading
Yeah.
other people's money with futures, and now advising other people's money with all sorts of stuff. But just on those two, do you miss the days of the CTA? Or was like
I
what were
do.
the pros and cons? What were the ups and downs of that life?
Yeah, so each one came with its own sort of I'd say interesting experience, right? Obviously the floor days, it was the early part of my life where you're younger and just that whole environment and so on really appeals to you, everything about it. So it was fast paced and I'm really glad and fortunate I got to experience it, right? It's not something that most people have ever seen or witnessed. The CTA side of it, it was completely different. You go from that to it's more institutional, and the nature of how we're investing in the decision making process was very different. It took me a while to get used to that notion, right? Where in the floor it's all about edge, in short-term trading. In that world, at least the way our strategy was positioned, is more long-term trading, and there was no longer that edge. And that's the part that really bothered me for a long time. I'm like,
Mm.
where is the edge? And then you start realizing that the edge comes through your strategy design and your strategies and the team you have in place and so on. And then this world, especially given where at the stage I'm at in my life, I think it really complements it because it's a lot more personable, right? Like in the first part, it was all about me. The second part, it's very sort of transactional, institutional. Here, a lot of people that I'm sort of working with are people I've known, there's relationships, and you covering the entire gamut of their wealth situation, and which is a tremendous amount of responsibility that I don't take lightly, right? There's a lot of different facets. I mean, investments is one part of it, but then there's other parts of it, right? There's estate planning, financial planning, and all the things that comes together. And that person is really leaning on you to guide them through this journey. And it feels really rewarding from that perspective. So yeah, so they each have their own, and I think the way they stacked up, now that I talk about it, I think it really was the right way. Like given the younger years, was this like, really like charged up, full of
Yeah.
testosterone floor days to eventually like this more
Is that when
nuanced.
you learned your jujitsu? When you had to fight for some fills on the floor?
So it was a little bit after that. Yeah, it was shortly. It was towards the end part of it where yes, I got hooked onto jiu-jitsu, and I don't think we want to open up that Pandora's box because then I'll
Yeah,
just won't
we want
shut
to hear
up. Yeah,
it.
this entire podcast is going to end up being like about Brazilian jiu-jitsu. So
Give us the quick. You won some medals at like the what do they call them? The Pan Am Games or something, right?
yes, I did win. I took second place a couple of times, both in gi and no gi.
It's called the silver medal. Let's give you the silver medal instead of second
Silver
place.
medal. Yeah, I did win the first place at a color belt in the old man worlds, which back then was in Brazil. This is before they created the mat world masters, which is for
Mm.
30 and up. So I did win that in Brazil as a color belt in my weight division. And then here, yeah, I took silver a couple of times at Pan Am's and the World Championships at color belts in my age group.
That's
So
what I tell my son. I'm like, hey, you're getting to that age, you're gonna start getting in fights and bar brawls and stuff. Like, watch out. There's some guy who knows jujitsu or something and just have you on the ground begging for mercy within 3 seconds.
yeah, so
The
what the funny thing
wrestler,
is?
like, could you beat a wrestler, do you think? We're going off script here, but I would like to me, I was always beware the guy with the cauliflower ear because they'll take you down super quick.
So that debate has been put to rest, right? That debate was pre 1993, and then the Gracie families kind of prove it through the original UFCs, the first four
Oh,
UFCs. That clearly, if someone purely is a specialist in their art, that Brazilian Jiu-Jitsu will come top on top. Now, this with all the respect to wrestlers, and we have a lot of wrestlers, and I really respect the sport of wrestling. But the wrestling is not designed for submission. It's a sport. It's not designed to,
yeah.
uh,
If you're down, you all right.
right, right,
Next point. Yeah.
right. And the wrestlers, once again, phenomenal athletes. They really adapt well to our sport. So yeah, jujitsu does that. However, interesting enough, I want to, I think there's, and we're all going way off script, but when you think about fighting and so on, there's two components that always adds to it: alcohol and ego. And if you really remove that, 99% of the fights wouldn't happen, right?
Yeah.
But a lot of it is also insecurity. So before jujitsu, I was a lot more prone into, but getting into fights or something like that. But the more I did it and the more better I got at it, actually that desire went away because I think once you're more secure that, I have the ability to clearly handle myself, especially against someone who doesn't know, then you're like, why would I
You're like,
engage?
I don't want to get my shirt dirty. And yeah.
That's what
Like,
yeah.
but on the floor, like, right? So what all the fights on the floor were those ego or alcohol? Both
I said there's another third component to it.
drugs. Yeah.
Right, right. And which was like, which was crazy seeing grown men. And it was from all walks of life, right? People who were like Harvard MBAs to all high school dropouts. but behaving the way they did, it was
But
interesting.
that all had that same, like a little bit of a screw loose, like someone who would be, I'm going to go compete in Brazil in Brazilian Jiu-Jitsu, right?
Yes,
Like,
there was those people that yes had a screw loose that did that too. Yeah.
um, so getting back to it, and then I wanted to say on the CTA world, I was waiting for you to be like, oh, just the raising money and dealing with the investors was terrible and a hassle.
Yeah, so the CTA world, the challenge with that was the time, like, we launched in '07, and in '08 net of fees were up, I think about 12 or 14%. So that was great. Then what happened was is we got this rip from '09 that never looked back. So it was a tough sell,
Inequities. Yeah.
and yeah, inequities, right? So it was a really tough sell of people that, that you need this asset class of what it does. And it was a very difficult environment too. Then you got that with, like, 0% interest rates. I mean, it was like a compounding effect where the strategy for the most part was really having a difficult time raising assets and so on.
And you're competing with long short equity, then private credit. So what did that look like where you're like, screw this, like I'm stop fighting with these guys and join up. Like there's good stuff here.
Yeah, so back then, so yes, so there's two differences. Like now, retail has exposure to private equity, private credit, right? Back then they didn't, the wealth management side. But back then, and yes, private equity hedge funds were always around, and it was just competing with like just the equities in general. Because even
Mm.
like the more sophisticated, places were just like, well, right now, let's just ride this thing as long as we can ride it, right? So at that point, it was like, okay, there's clearly something here, but I think could be applied much better and more efficiently on the other side because of, more importantly, the democratization of alternative investments that's now available in retail, just in the past 5, 6 years, where it wasn't available back then. So I'm like, okay, there's clearly a value add. And most importantly, is right now, I'm offering only one component of the universe of alts, at least the way I perceive it. I always say there's like multiple components and each one does a different thing. So now if you go over here, instead of me being a guy fighting with them, let me be the guy to try to pick the best horses for the end client. And that's kind of where we're at today, which is great. I mean, once again, the minimums are much lower. Retail can get in, and now instead of me being competing on against one component of it, I'm on this side being able to pick from the best of the 4 or 5 components.
Right. Instead of like, hey, you need managed futures. Now you need some managed futures. You need
Yes,
some of this. You need some of this.
yes, and they
Um,
all do, provide a different thing.
Take us back farther. Was it tech company then became an RA? What is farther? What's the story there, and how'd you get hooked up with them?
So Farther was founded by Brad and Taylor back in 2019, right before COVID. And it's backed by VC. And the premise for them was that the industry as a whole, from a technology perspective, is antiquated, it's outdated, and it's
The RIA industry or the investment industry?
just the wealth management industry, whether
Yeah,
it's
yeah,
on the banking side or RA side. I mean,
yeah,
Brad
yeah.
came from Goldman, uh, Taylor was at Fidelity at one point. So they're like, it's broken and it's really ripe for disruption. So, and initially it was sort of, the parent company was a fintech company.
But were they trying to be a robo advisor, like a
No, no. So the
I can't
robo
even remember some
advisory,
of their names. That was the biggest thing
yeah,
in
yeah, no. So the
2018.
robo advisory model, it's that one. I don't think it has panned out to be what people thought it would be. And the
Yeah.
reason being is because, if you have a very simple financial situation, or if you don't have that much money, yes, you can just use robo advisory. But people with complexities, people with, a decent amount of wealth, they like the technology component, of course, but they also need the human interaction, right? They need that expert advice and kind of bringing the two together. And I think what makes Farther really unique is this is sort of like where we integrating like the modern wealth experience with expert advice all into one place. And this story has been really amazing because when they launched in 2019, they launched with $400,000 in AUM. And then when I joined just 2 years ago, we were about 600 million in AUM, and today we're about 8 billion.
Ooh.
So there's been a tremendous success and growth because
All because of you. You're like, as soon as you joined, boom,
yes,
7.4 billion came in the door.
that exactly. I'm glad you get that, Jeff. I don't know, for
Yeah.
some reason most people don't understand that
Well,
part
it's
of it.
going to come back to me because we use you for some of our personal stuff. So yeah.
Yeah,
If only I had the 7.4 billion.
yeah,
Um, so a few things you said there. One, interesting to me that you're saying people want advice because that whole robo model was like, hey, which I see with younger people. I don't want to talk to somebody. I want to do it on an app. I don't want to have these big conversations. I just want to click, click, click and get things done. So are you saying at some point that tips over of like, okay, once you need some trust, once you're putting money offshore, you're setting up this or that, like it just becomes too complex in the tech world
yeah.
to
So
do?
think about it this way. Let's take a dentist, for instance, that's going through, like there's a lot of these roll-ups, the DSOs and the private
Yeah.
equities coming up.
Aspen Dental.
Yes. So let's say they want to go, they're going to go through a liquidity event. So right off the bat, because once again, we're looking at it, and that was the thing that I learned, by the way, through the process. I wrote an article on LinkedIn that, I came at this industry purely from an investment perspective, and the investment piece is important, but there's a lot of other components when we're talking about wealth versus purely money management. So through that lens, they want to talk to someone, okay, how much is my practice worth? You start from the valuation process. Then you start
Mm.
talking about the exit planning and then the tax mitigations. Like once I go through an exit, how do I position myself? How does the world of the DSOs and the private equity and roll-ups work? So this is where the advice part comes in if your team has those like, components to it.
What's a DSO for my friend George?
The DSO is the dental service
Got
organizations.
it. All right. Yeah.
Yeah, yeah. And
I
so
want to throw in the
I've said
Seinfeld
DSO for so
clip
long that
here.
I had to
You're a
think of
rabid anti-dente.
right.
Um,
So when so you go through all those components, then there's a estate planning and all of that. Then the last part of it then becomes the investment part. Now they've gone through a liquidity event. They've had the transaction. You make sure everything has been set up properly on the periphery. Now we're talking about the investment piece. And then even that part of it, instead of just using robo advisors, where you're basically at the mercy of the market, riding the market up and down, then we can kind of, start taking a more conscious approach of, obviously what are your objectives? And then through that, how do we mitigate and manage risk? And then comes the implementation of, different alternative investments. How do you overlay it? What kind of market environment we are. And then these are all the things that, a robo advisor just can't provide. Now, if you're in your 20s and you just want to like, you're a W-2 employee and trying to sock away some money, sure, that could work in that context.
but it's weird to me because maybe we should start a new group of like the alts should be available in a robo, right? Like you can do there's ETFs now, there's all sorts of stuff you could do. It's just their models or they're not willing to stick their neck out and throw the alts in as a big component.
So yes and no. So there's a couple issues with that. First of all, when we say alts are available, and you know this stuff better than anybody, not alts are created equal, right? There's different types of alts. Each alt does a different thing, is the first part. The second thing is the alts that would be, I'm assuming, available in a robo advisor model will be purely just liquid alts, managed futures, which is only one segment.
Yeah.
The other part is sort of like, the custom notes that I do, or the private equity, private credit, infrastructure, and all these other components. I doubt it if you could get that through robo advisory because I know the process of getting into those. As you
Yeah.
know, I've
Well,
aged.
some like
And
the right? I think it's moving that way. You can get there's like venture capital replication ETFs and private credit replicate, but then
they're
we
not.
wade into the whole world of replication versus the real thing. But
Yeah, there's replications. They're not structured the most efficient and effective way. It's just like go to market, let's just provide this format of it. But why settle for that when you could get the real thing?
yeah,
Especially given this environment that now it's available to you to direct access to, the platform of a private equity firm
yeah.
and so on.
All right, I'll stop trying to fix the robo advisor model. Um, So
You a big stakeholder in the robo advisory firm that you should
yeah.
disclose, Jeff?
No,
Or
it just was like, remember, it was such a big thing, and now you hear nothing about it anymore.
right,
And you'd think it'd be like infinitely more now with AI and everything that it would be top of mind for everyone, but it sort of died
right,
out.
yeah,
But you said something super interesting to me, and this comes back to your days as CTA. Like when you're selling the CTA, especially into high net worth family offices, and probably still fall into this trap. You're trying to sell this track record and this, and look at how good the Sharp is and the correlations here. It's you're so myopic on the benefits and the investment benefits and that's like ninth on their list of important things, right? So as you said, they want to talk about their valuation, the tax mitigation. So where do you think that investment performance is, I'll say, at farther and versus like the whole rest of the world? The investors you're talking to, where is investment structure on their list? Pretty low?
ah, okay. So now you're really getting into the weeds, and these are very okay. There's a couple of things. What I'm about to say, it relates to me and my team at Farther. Like, there's different advisors. So to be clear, I'm not speaking on behalf of Farther in this sense. So when I think of the investment piece, and you mentioned Sharpe ratio, to give you an example, and this is the world we're operating in, and this is why I really think there's a value add for what I do. I was in a group thing discussion and a very successful, I mean, extremely successful advisor. And here, success being defined by AUM or revenue generation, right?
Yeah.
Was mocking me for wanting to know the Sharpe on my client account. So Sharpe is like, "Pff," like, he goes, I've been doing this for 20 some years and no one's ever asked me. And, so this is the environment that he's bragging about. Clearly he doesn't know what the Sharpe is and so on for his client accounts, and he's saying why he need it. But that's where I say that's where my responsibility comes in.
Hmm.
Regardless of how important it is for them, like you and I know that those things are important when you're creating an investment for the client, right? So part of the I think the importance of our business comes down to trust. Meaning when they come to me, it's this trust that they have in me that I'm going to do the right things, regardless of what parts of it they understand and they don't understand. So through that lens, it matters of how I view all those metrics, and I take the exact same approach as I did running the CTA. And to go into the extreme lengths of Jeff, I spent the first 3 to 6 months compiling a data set for the private equity firms because you just can't get data in this industry. And everyone's like,
Mhm.
because everybody looks at the 1, 3, 5, 10 year numbers. I'm like, what does that mean?
Yeah, I
How
know.
can you, like, well, I'm like, no, they're those. I need
That
monthly.
is the biggest jump from our world to that world is just I'm used to looking at the monthly table. Here's the years, here's every month,
Right, right, right. No,
and
no,
then
for
all the
them.
metrics. And now it's just like 3, 5, 10 year per. I'm like, wait, what? I
Right,
want
and
to
then
know.
and they
Yeah.
push back. Like, like we've been doing this for 20 years. Like, who are you? I'm like, okay, that's fine, you've been doing it, but this is the way I know how to do it, right?
Yeah.
So I had to create, and you can't even get data. It's like pulling teeth of, obviously with symbols, you could pull it, I have different data platforms. Here, I had to reach out to, and then with private equity, they have all these different vintages, this, so it's even hard to get a continuous track record. That's a whole
Hmm.
different story. So to create this data set, to be able to do some modeling and look at all the things that you mentioned, like, what's been the standard deviation and dial it in. So those are the things that, I talk about it. I know, most of the times, a lot of the end client or investors don't understand it, but that's okay for me. As long as, I did my job of explaining it, but more importantly, it's my job to keep an eye on it and make sure it's being done the appropriate way, whether they appreciate it, don't appreciate it, realize it, don't realize it, because that's the right thing to do.
Let's go back to the guy who doesn't care about it, or maybe doesn't know it. Maybe they intuitively know that when I put these things together, it works out, and they don't actually know the math. Um, right? It's kind of to the point of that guy. Like, well, the investor doesn't care. Why do we need to worry about it? I see your point, like, because I can't sit there across from the client and with a straight face without knowing it to the core, without knowing the math.
Right. So if so so one thing is, look, once again, a big part is education.
Yeah.
And like I said, at least in this world, a lot of it is based on trust and relationship. So even though they don't get it, if I tell them, if you trust, these are the things that are important, and especially because of my background, they'll understand it. But like this, from what happened just a couple months ago, it was a tremendous opportunity for me to finally showcase why we do all the things that we do.
Mm.
Because for a lot of like the portfolios, you know, the drawdown was like roughly, 30 to 40% of what like the S&P drew down 19%, and a lot of like, average accounts were down anywhere between 6 to 8% only, right?
Mm.
But on the flip side, we were able to capture, 60 to 75% of the upside. So, and this was actually an extreme example. It turned out really well because, like your drawdown could be only 6%, but you were in cash.
Yeah.
I
Yeah.
mean,
Yeah. You did it.
and you did it. So that, yeah. So I've had people come to me and say, I didn't lose any money during this period. I go, okay, how much have you made? How much did you not participate leading up to it? So you understand. So it's dialing in the upside downside capture of it. And when that happened, I took that as a tremendous. I went to everybody to say, see, I know I keep poking you guys. You got to sign all those DocuSigns, but this is the end result.
Yeah.
And because the other problem is, and I've still have yet to see in any religious scripture, regardless of your religion, or the atheist book for that matter, for the non-believers, where it says the market will and has to be higher 5 or 10 years from now.
Yeah.
I'm
Which,
not
but
saying
that
it's
is treated as scripture. You're right.
right, and
Yeah.
I'm not saying that it's not. I'm saying I don't know. If it is, great. Let's make sure we ride it. But what if it's not? Let's have some guardrails and things to sort of mitigate it if that doesn't happen. Because, the one thing is, oh, in the long term, because everybody's been so conditioned, just buy the dip and eventually it'll come back. And people tend to forget from, 2000 to 2013, the market really didn't go anywhere. Where had you had this conversation at the beginning of 2000, it took almost to 2000. I mean, oh wait, we made a slightly new high, and then it took 50% drawdown, and then it took until
Yeah.
2013 where the market made a new high, and during that time we witnessed two 50% peak to trough drawdowns.
That can't happen again.
No, no, it can't happen again, especially
Um,
now.
yeah. I can't let this go. I'm going to try one more time. Like, why do you think the clients get so much benefit out of the tax advice and estate planning and trust setups, all that, that they forget about the investment performance? Like, it always still boggles me of why they don't
No,
care
Jeff.
as much as they should. Or
No,
is it
no.
because the industry's created these documents that make it hard to actually know what your own performance is?
So it's beyond that. And by the way, everything I'm saying now, it's on my behalf. I don't want to. I'm not representing farther in the things that I'm saying now, but it's actually the industry's fault because most of even a lot of the advisors in the industry don't even understand that. They're like, what and they're like the markets are going to do what the markets are going to do. And I've had advisors talk to me like saying, well, investments is that important. Like, there's plenty of advisors who've done amazing in investments. And I'm like, no, what
Yeah.
they failed to realize, they haven't done anything. It's the market that's
Yeah. Yeah.
basically, and now I see so many client accounts that from other places and so on that when I run analysis, and for the most part, um, they've underperformed on the upside and they've pretty much captured the same downside. So this actually the client is the last part of it. Actually, the client here at that point, since it's your client and it has trust in you, takes what you're saying, that it's worth it and it's important. And like, okay, Kevin, you do what you have to do. I trust you in that. But
Yeah.
it's more of like so like going back, I talked to I think it was like 20 firms before I settled on Farther, right? And when I would bring up these conversations, I mean, and these are like, like they just like look at me like, are you nuts? Like, what are you talking
Yeah.
about? Like, your
But
job
as
is
part
not
of it, like, don't upset the golden goose, right? Like, this
right,
is, and whether they're lucky or good, it's paid everyone's bills for 30 years. Like, just ride the market. That's what makes you money. That's what makes the
right. Like
clients money. Don't mess with it.
right. Your job is to gather assets, not to fiddle with these types of things. Like, you just
Mm.
like and so and 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 to Farther's credit, they were the only firm when I talked to them about this. Even though, they at the time were coming at it from a different perspective, the technology end of it. They were like, okay, this makes sense. We are sort of thinking along those lines, not as like deep, at the stuff that you're talking about, but it's a good fit. You come here and they've been really open to adopting a lot of these aspects and components on a firm wide and so on and so forth. So yeah, but it predominantly, and I think uh, if we when not if because I mean and I have a chart I show people from 1928 the consolidation period is the 1920s, and then you have the stagflationary period, I think, like in the sometime in the 70s, early 80s, and then even in the mid 90s. So if we go back to more normal market cycles where you have consolidation or drawdowns, I think some of these things are going to start resonating. And
Yeah.
just as like when I was talking to those firms, like 2022, every time there's a big drawdown, all of a sudden everybody's all ears. Let's talk about risk
Yeah.
management. Let's
Yeah.
talk about all. And then market reps are like, I don't need that. Just buy
Right.
the dip.
Could you argue that all the trillions in wealth management, and because they're blind to this, like that won't happen again? Like there's a, right, Josh Brown wrote a blog a long time ago of the constant bid, the never-ending bid. That's just all this 401k money, all this W-2 money just going straight into equities forever. We'll just keep this constant bid. But I mean, yes, until, right?
Yeah, and here's the thing. So that's
But
a
that's
big part
real
of it.
quick. That's my problem with some of the 20s comparisons of like it was very different. Right?
Right.
There wasn't auto debit into your investment account and all that stuff. It was like
Right.
the whole world since then's been built to make you stay in stocks and put more money into stocks.
Right. So that's a big part of it. And then the other issue is that the people, like the part of the industry that's now adopting it and understands these things, right? They're slowly saying, okay, we do need uncorrelated investments and so on, because the whole point is, I say you can't manage your portfolio on a two-legged stool of stocks and bonds. You need that third leg. I
Yeah.
know Rodrigo right now is doing backflips,
Yeah.
but and especially given the fact that the other two legs in the past couple of years have become even more correlated, right? So it's even more important to have an uncorrelated investment scheme. So part of the industry is slowly waking up and understand that, but the problem is that they think the savior now is private equity, private credit,
Hmm.
where I really like private equity and private credit, but I don't consider them as true game changers or alts. Meaning, if we get hit with an 08 type scenario, those asset classes are also going to get hit. Maybe not as much, and especially now, another thing that makes me a bit concerned is it's like they've finally realized, wow, there's trillions of dollars sitting on wealth side. So they've opened up the spigots and they are just courting the retail wealth space. And there's a lot of money flowing in. So what are the ramifications? So you got to make sure you go with the right managers who know what they're doing. I was joking around with someone the other day. I said, 10, 12 years ago, everybody and their grandmother was roasting their own coffee beans, right? Then
Yeah.
came the microbreweries. Everybody's like brewing their own beer. Now everybody's starting a private credit fund. I can't tell you how many
I
people
know
were
this.
like, hey, I got private. I'm like, really?
What? Yeah.
Yeah. So
Um,
even I go on all these like conferences now, and the entire alternative investment conversation is around private equity, private credit, and I'm like, okay, well, you guys are getting a part of it. So I call like actually private equity efficient beta. To me, it's more like it's more beta, but capturing it in a more efficient manner versus public markets, especially given the ridiculous valuation of where things are today and so on.
are you seeing, which we've had a couple people on the pod, like distributions dried up, like the seems like there's cracks starting to show in the private equity model in the funds?
Yeah, so right now what you're seeing is, and which was interesting, coming into this year, it was supposed to be a great year for like private equity. But given all the uncertainty around the tariffs, and you're starting to see this huge sort of divergence between the public markets and the private markets. Right now, liquidity is dried up. There's no M&A activity. So a lot of these like vintages are sort of like, it's like year seven and so on. They have to get out. Now they're stuck.
Hmm.
They can't offload. So within the private equity world, right now the opportunity is like in the secondaries, right? So the secondaries are able to buy these at discount. So there's nuances in that world. But yeah, you're seeing cracks at some of the the direct buyout growth space but then at the same token, that creates opportunities in the secondary market and so on. So even like when you start thinking about creating the private equity sleeve of one's portfolio, you have to sort of think about these other nuances within it, not to mention the quality of the manager and so on and so forth.
Um, one more bit on private equity, then we'll switch. Were you right? We used to always rail against they don't have to mark to market, blah blah blah. Like, do you see that now as a benefit instead of a right? Because it helps smooth out portfolios. It helps
Yeah,
everything looks
yeah.
better in
So
the back test with the private equity in there.
yeah, so it's interesting. So first of all, there's been a lot of evolution in that space. Meaning in the old days, it was all the drawdown vehicles, right? 7-year commitment, drawdown.
Yeah.
That's a whole different. Now there's a lot of these evergreen structures where they show up on your custodial statements and you get monthly mark to market, right? Having said that, I think private equity, they always have this notion of they can market wherever they want. So that's a different story. However, yes, you picked on something that most people don't understand is by a function of monthly reporting in itself, that's one way you reduce volatility.
Yeah.
And that's why they're mistaking that, they think it reduces volatility, it's less correlated. It's not that, it just from the monthly reporting is one factor of it. The second thing is, and I looked into this, is the private equities really outperform the public markets. And I like this space, as I mentioned. However, it goes back to blending in managed futures into a portfolio. So through the lens of, if you were to compare on like the purely, let's say the bottom of just like 2 years ago prior to January, you see that private equity lagged the public markets. We're on a tear. It's only after when you get drawdowns in the public markets where private equities drawdown is less that it allows it to start
Yeah.
outperforming and recapturing the high watermark. So these are the subtle nuances which
But I could argue that not real. Like the private should have been marked down at the same public market, right? That's the rub. Like that it's a feature, not a bug, that they're marking it less so in the drawdowns on purpose, and the pensions, all the endowments know that they're doing that, but it helps them keep their job. Look at how less volatile we are. So everyone's in on the game.
um I don't know if I look at it that way because at the end of the day, wherever they're marking it, if you want to get out, a lot of them after like especially in these structures. I mean, I use mostly like these evergreen structures now. Like,
Yeah.
if you give them like a month notice or quarterly redemption, you can't get out of these marks regardless of where they're. So it's not as I see what you're saying, and definitely
Yeah.
that's a part of it. The fact that where the price discovery really is, but
Yeah.
at the
Cliff
same
Asness calls it volatility laundering. Yeah.
right, right. But to be fair, like you can get out at those
Mm.
prices, and so I think they provide a value add, but not through the way I think a lot of retail is looking at it as a savior of,
Yeah.
that's all I need for my alts, and that's it.
So let's switch gears. So you found farther found you, then you're starting to create client portfolios. You said what it was like 3 to 6 months of creating portfolios before you even started talking to clients. What did you find? What hit you right away of like, oh, this is way better than I thought when I was just stuck in the futures world, or this was good. Like you mentioned private equity. What else stuck out to you? And then how do you kind of think of this puzzle of like which pieces did you find attractive and which pieces are you keeping in portfolios for the clients?
Yeah, so I think initially I was like a kid in a candy store. I have access to all
Yeah.
these different. I was like, wow, this is amazing, right? On the flip side, I think I aged like 30 years just trying to get these things implemented and
Yeah.
executed in one client account because there's a lot of, there's taxable, non-taxable, there's various accounts and so on. That's a whole different story. The couple of things that was surprising. Actually, I was surprised with some of the hedge funds, to be honest with you. I'd never really taken a deep look at the hedge funds. And then I come to realize there's a reason why millennium is millennium,
Yeah.
Um, and because,
The
they've had,
stats are ridiculous. Yeah.
yeah, I mean, the numbers are like, there's a few of them. This was a plug for millennium, but anyhow, there's a couple of them that I use that the numbers are really, really solid. And through different market cycles, kind of they provide what the managed futures world does, but a lot more consistent.
Hmm.
And if the only thing is, you're not going to get that sort of crisis alpha component of managed futures within them, right? With some of them. And then another thing I don't understand why they do this is a lot of them are running at very low vol strategies. So I
I
don't
know why they do it. So you put more money with them.
more
Yeah.
money in it. Right, right, right.
Yeah.
We know why we do this, right? So in one challenge is like when I do this, I'm getting a vol crush in my portfolios, right?
Mm.
So my portfolios are running like, at 8, 9 vol versus I'm like, okay, how do I goose this up? So the surprising part was some of the hedge funds, the way they behaved. Obviously, I started like modeling the private equity behavior. I'm like, is private equity really this alternative investment? And I realized very fast that that's not the case, but it's efficient beta, right? So I could kind of shave off part of the beta on that. And then the other component, I really like using the notes, like, the structured notes that I do customized notes. So that part being able, and then the way I view it, by the way, going back to your question, is sort of like private equity is the sort of like the beta part component of the alt sleeve. So if we have
Mhm.
like up markets, that's going to, where managed futures, some of them are going to be lagging, that's going to drag it up. Private credit is sort of like the fixed income part of your alt sleeve, but with its own nuances, meaning, right now you're getting about 8 to 10% steady yield with a steady NAV. However, if we get through like a COVID or 2008, then NAV will take a dip, where traditional fixed income might get a bit, flight to quality
Yeah,
aspect
yeah.
of it. So that's those pieces. Then I
But
use
sorry, I'll interrupt you real quick. Like, why do you have a equity in a bond portion of your alt sleeve?
so for
Right?
two
So is there a
reasons.
traditional?
Yeah, yeah, no, no. So two reasons. So the way I think about it is, let's say take a simple 60/40. I'll shave off maybe 5 to 10% of the 60 to redeploy it in private equity.
Okay.
So I'm getting, it's sort of like I get both feet, and part of it is pure beta capture,
Yeah.
the more efficient manner that technically isn't within my alt sleeve, the way that it gets compartmentalized in our space, right?
Yeah,
And
yeah. All
not
right, I
all of
like
them.
it.
So like, some of the private equity funds that I use, like, they get like a 0.55 correlation or something like that. So it's not as correlated. So that's why I use it. And then so that's private equity and private credit. So I use them to manage futures piece, which is a smaller piece of it for two reasons. A, since there's look through, most people can't stomach it, the
Yeah.
volatility and the drawdowns. But I use that for like the tail
To
risk.
my earlier point. Yeah.
Right. Right. I use that for the tail risk hedge. And I say it up front. I say, listen, you see this? This thing could be down 20% on the dailies, and we're going to be okay with it. There's a reason why it's there. So I actually over exaggerate, like, the horrors of it. And
And
I
then you
say,
pointed to April, May, like, see, I told you.
right.
Like,
So I said there's a reason for it, but I don't, you can never, I don't want you to complain about individual components, right? You need to see this thing as a combination. And so long as our upside downside capture is far better than a typical 60/40, that's the objective, or 70/30 or 80/20, whatever we're targeting against. So managed futures will be sort of like the tail risk part of it. And then hedge funds is kind of like your all weather
yeah.
component within that. And then I love the notes that I use it tactically given different environments, and I kind of dial it in and so on.
And then on the hedge funds, are you dialing into different strategy types? Like, what does that look like? Of just purely off the numbers of the best absolute return? Or are you looking for, oh, I'm missing a distressed debt manager, or I'm
No,
missing
so
a,
yeah, so I don't go no, pretty much a lot of them are these multi-strategy sort of like macro, they do everything
yeah,
along the sun. And really when it comes to due diligence, that's another hard part, right? People are just like generically, so due diligence is very important for me, but I've sort of have made this decision that obviously the numbers are the numbers, that's important. But also, I'm going to go with the biggest and most well-known names just from the blow-up risk.
hmm,
I'm willing to forego the outsized return of some emerging manager because I don't have the time to watch him 24/7 and be on top of him and do the proper due diligence. So I'm going to lean on, multiple layers of, like, Mercer, for instance. Like a lot of the funds that I use, like Mercer's done a full due diligence report on him, right?
hmm.
So check. The manager, ideally, I want him to have been in business prior to '08 to see how they've done in '08. Check. Length of track record, and then go with the more bigger and well-established names, and then really use diversification. So a lot of times people like, a lot of clients hate me in the beginning because I have to, get into all these different, like, why do I need all, my old advisor, you put me in one private equity and that was our alt sleeve. I'm like, well,
Yeah.
that's not the way to do it.
And then you're talking to me, we're like, no, we want more. Yeah.
Right.
Yeah.
Right.
Send me more
Exactly.
DocuSigns.
Right.
So that do you view so that hedge fund bucket, do you run that separately as correlations, or each one runs its own correlations and analysis inside the portfolio? Like, do you bucket that whole sleeve?
No, so I run the whole thing. So I run like, and the hedge funds normally is like only one or two because like, the minimum investment size. And if you want
Mm.
to fit all these pieces, so you run the correlation, make sure that if you're using like the two hedge funds or three hedge funds, they're uncorrelated. Then you take the correlation of that to the broader portfolio and then with the rest of your alt sleeves. Another thing that I was very interesting when I was doing all this exercise, and I thought the hedge funds would be very highly correlated to managed futures, and they're not. And that was a good thing. So when I run across correlation across all these different asset classes, they're all like truly uncorrelated.
And they weren't right. My fear would be they're more correlated to equities than I would prefer.
No, so the hedge funds actually know they're in their
Yeah.
own sweet spot, which was interesting.
But do you think that's because of the ones you're looking at? Like, was that
Oh, no, no,
your own?
yes, yes, of
Yeah.
course. Yeah, there's plenty of hedge funds that could have a much higher. Yes. Now you
So
have to
you
pick.
selected on purpose the ones that are
Yes, absolutely.
multi-strat, non-correlated.
Right, right, right. So that's what I'm looking for. Yeah, no, there's a lot of hedge funds. I mean, a lot of hedge funds get clobbered in '08 as well, as we know.
Yeah.
So, yeah.
And then do you think if you hadn't come from the futures world that you would still put managed futures in there? Or do you think you were biased and had this like, I know how this works, let me start putting in the like hard for you to answer, right? But if you didn't know about them, would you have found them as this non-correlated piece?
I think with managed futures, obviously living it and having the education of it and understanding it is very important. One thing I always tell people, Jeff, and this is really important. I'm known as like the alts guy or you like alt. I'm like, no, 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 no. I'm neither the alts guy nor I like alts. They're nothing but a pain in the ass. There's nothing more I would love to do is to sit there like a lot of people just click one button, 60
Yeah.
40, move on and move on with my business instead of spending, a month pulling my well, whatever is left of,
Pull
following
it out of your face. Yeah.
the trade ticket, this. I said the reason I use it is because it's needed. Unless someone shows me otherwise how I can manage risk, improve risk adjusted returns, not using any alternate investments through stocks and bonds, I'm all for it. Please reach out. But I do it because it's needed. And then through that lens, I use all these different these categories, which is additional extra work because I really think each component adds something of value that is needed, not
Hmm.
because I like it or I have a predisposed, like, love towards that industry. Like we all know, and you know this, like, on from a tail risk protection in a prolonged, in capital letters, people, prolonged sell-offs, managed futures have done well and they'll continue to do well. But they're going to be a drag on the portfolio as the times that we've seen. Now, is that a big part of my portfolio? No, but it has its place along with everything else, and depending on how you construct it to do what it has to do when we want it to do it, right?
I think the problem is you're be like it's needed in the portfolio, which I agree. Anyone who does the math agrees, but like all those people who don't do the math, it's just like you must be the alts guy because that's
Right,
all you talk about. Well,
right.
because it's needed. Well, no, is it needed?
Right, because and there's nothing else to talk about like on the equity side. I mean, I've seen, and that's why for like the other parts of it, I pretty much use the cheapest ETFs possible because and through that world, I've found very few managers have been able to beat the broader indices. So
Hmm.
why pay fees for something that you could get like, for 8 or 9 bips, like, a simple ETF. So we're gonna allocate the beta part of the portfolio through various ETFs. Now there will be some like tactical shifting, like international versus this or that or whatever you want to do. And then the rest of it, this part of it is where you really have to be very selective, do your homework, pick the right managers, and so on and so forth.
And then do you run into clients that are like, I just want NVIDIA. That's all I want. I want all AI. Like, how is that, or is that not a fit? You're like, well, that's not what I do.
No, yeah, so not everybody's a fit, but to be honest, I haven't ran into any of that. Like I've had some people and they say, I want all NVIDIA. Or like not all NVIDIA, but like I want to like do this. I want to get into this stock. I'm like, okay. I say, what is your exit? He's like, what do you mean? I'm like, well, what's your target
Just
on the stock?
forever? Yeah.
He goes, I don't know. I said, okay, where's your risk? what's your risk management strategy on this stock? Like if we get
What?
a stock that you love it, like where's your out? He's like, well, what do you mean? I'm
Look
like,
at the guy who got into Tesla at 850 or something. Yeah. Yeah.
right. So once I go through this exercise, that it's okay. And by the way, so I use a lot of stock programs on the direct indexing side. Now that is something that's worthwhile, right? Because you're harvesting losses, offsetting capital gains. So for me, if I'm going to deploy a lot of, and I have like large equity positions in those, but those are being professionally managed, and and there's for on a direct indexing side. So it's serving a purpose. A, we're tracking the indices because it's about expectancy of behavior, right? And on top of that, we're generating losses. But outside of that, sure, and we'll do individual names with clients, but then we go through the exercise of what is your risk, what is your objective, and so on. It needs to be a well thought out methodology and process to implementing a security in there.
Or like I do personally, I have my play account. Right. So there's not
Yeah.
much money in there, and I can take flyers and have fun and be like, oh, I was in this small nuclear reactor company that went up 40%. And but I know, and I have none of what we just talked about. And being a systematic guy, I know I need it, but it's like super small part of my overall portfolio. It's for fun. It's to kind of be in the game when I know that that's not really how to build the wealth, and then the rest of it is systematic in everything you're talking about. And that's how I compartmentalize the two.
Right, and I do yes. So I always recommend that too. Just have a play account, but then I say within that play account, depending on the size of your play account, take half of it and go to Las Vegas. At least you'll get comp.
At
They'll take
least you
care
get
of
some
you.
rooms.
There'll
Hey,
be
that's a new if
right.
the
So if you're gonna blow your money that way, then at least let's get some benefits out of it.
before you go, you mentioned the buffered notes. I was a little sad to hear you say that because I'm like, oh, he's really gone to the dark side now. He's doing these buffered notes. Um, I've gone back and forth on them. I want to really understand how they work. Give me your journey with the buffered notes, how you got there.
So I personally, in my own accounts, I would go 50, 60% notes. And I know the note thing, I've talked people, some people hate it with a passion. They think it's the biggest ripoff creation of Wall Street. And there's the other side, they think it's a holy grail. And the truth is obviously, as we know, with most things, it's somewhere in the middle, right?
Hmm.
It all depends on how you use it and when you use it and so on and so forth. So the way and I've looked into it, and like you said, how do they do this? Because initially I was a bit skeptical too, but then when I looked into it, there was two things. And we can, at a different time get into the weeds of, how they use derivatives to do it. But a lot of times your capital is tied in, you're not getting the dividends on them, and so on and so forth. And then at the end, it came to I checked it and double checked it and rechecked it. I talked to an attorney, and they said, listen, so long as the bank is still solvent and standing, they have to pay you out based on the terms of the note. So it sort of puts your mind at ease of not trying to drive yourself crazy of how are they conducting the trade on the back end. Meaning if they say if the S&P is up X, we have to pay you X by this date, they have to do it.
Yeah, no matter how they got there, whether they
No
bought
matter
the
how they
options
got
or
there,
not.
so long as
Yeah.
they're solvent, right? But even if they were to go under, and that's why I only use a handful of banks like JP Morgan, like RBC, like AAA rated and so on and so forth. So regardless of how they got it, they got to pay. Even if they file for bankruptcy, by the way, let's say if I am holding a JP Morgan note and you're holding a JP Morgan stock, I will get paid ahead of you because it's considered unsecured debt.
Hmm.
And the last scary thing that we saw in that space was Credit Suisse. When they went under, but even in that case, all the Credit Suisse notes were made whole by UBS and so on and so forth. And for the most part, I only use it on the indices. And I use it in a lot of times I use custom notes. I don't use off the shelf notes. And by the way, you have to be aware of depending on a lot of the wirehouses, there's fees baked into it and so on. So that's a whole other game that you have to be aware of.
Yeah, that's my brain is like, well, if this seems too good to be true, so someone's making money off of me. Like if I could structure it myself, I would make
Yeah,
this
the
plus
problem is,
X. Yeah.
some of these things, like, there's no way, like, it's gonna be very difficult for you to structure yourself, and then you have to be on top of all aspects of the trading part of it,
Yeah.
right? So they have these banks have big sophisticated desks.
And what we talked about before, like the bank has some other exposure from some other clients that they might be offsetting. So they might not have an economic incentive to do exactly the structure you're thinking of.
Right. So, like, we were talking about it before, like right now there's like a custom note that, just created that has like a look back period, meaning from the trade date, the next 6 months, wherever the market lowest price is, that you're going to get that entry. And on top of that, you're getting a 10% hard buffer at maturity, which is 5 years from now, right? So to me, for a lot of cash coming in, given all this uncertainty, this, potential, war and everything that's going on, I'm like, okay, if someone could obviously is okay with the 5 year time horizon, as not all of it as part of the beta, let's capture the beta and it's tied to the S&P. And I, like I said, most of my notes are tied to the S&P or the three indices, right? Let's get in this way where if once we get in, if the market continues to go higher, fine, we'll participate in it. But if there's any big drawdowns in the next 6 months, and given some of these things, it's going to work itself out in the next hopefully couple of months, at least on the geopolitical front, not domestically, then this thing would reset and we get the lowest price. So it's kind of using it tactically versus if let's say we were in a 30% drawdown, I'd be looking at structuring a completely different type of note where maybe we're getting a 2x upside exposure.
Yeah.
So you could really dial it in, especially the fact that you could use custom notes or create, like in our case, you could really dial it into different market environments. And then on top of it, there's like yield notes too, right? Especially when the vol spikes. I mean, you could get yield notes even, right now, like around 8-9%.
Hmm.
So
There, two things on that. One, my worry is that there was a podcast, or there's probably exists something back in 07, 06, like, no, it's just the bank solvency is all that matters, right? And everyone's like, these mortgage-backed securities, as long as the bank's solvent, you're going to get paid out. So that's, yeah, known risk. You're mentioning that risk, but it's as they become more popular, as they get much, much bigger of a piece of the market, like that is a worry to me. Like,
yeah,
not just solvent, but if they have to pay out all of these at the same time, it could get ugly.
yeah. So I've looked into this. Actually, note business, from my understanding, is much bigger in Europe than it is in US. It's
Yeah.
still a small part that's growing. And the concern has never been the other thing, the solvency risk for me is big. I mean, you'd be surprised how many times initially people are hesitant getting in, and then when they see its behavior. So we had some notes mature like right at like in April, where the market was down 19% and they're getting like 10% return. Like,
Hmm.
and now they're saying, "Hey, put all my money in these notes." I'm
Yeah.
like,
You're like,
no,
whoa, whoa, whoa. Yeah.
right? I'm like, so, and they're like, well, if JP Morgan goes under, then we have bigger problems. I'm like, yes, but just
But
there's
yeah.
certain rules I put in place. I'll limit exposure to X percentage and so on, regardless. And by the way, within that, let's say if 10% of the portfolio is in notes, not all 10% is JP Morgan. It's part of his JP,
Yeah.
part is RBC, BNP, and so on and so forth. So we use the same concept of diversified alt sleeve. It's a diversification against different time frames, different issuers on the note
And
side.
then plus having the alts there and the managed futures there, right? In some scenario, likely those tail risk things are going to pay out, right?
Right,
That you're
and
going to
don't
have.
forget a lot of these notes. So there was another case with a client who had it was a taxable account and it was complicated, but they couldn't sell for various reasons, but they had some cash. And then there was like whether you do an option. She wanted some protection against a falling market, right? So you could create like a bearish note where, you get your principal back if the market goes up, but you participate on the downside, stuff like that. Now that you could do that through options, but then this was like a easier way versus like, she didn't have option accessibility at the time. We had to launch one. So once again, I think it's all how you use it, how tactical you are within, and how aware you are in what scenarios we are versus just calling the desk if you're on that model and say which note pays the highest commission and load up your clients in that note. So
Hmm.
clearly, in that sense, yeah, it's a disaster. But if used appropriately, consciously, tactically, I think it's just another piece. It's not the holy grail, another important piece of the portfolio that could really have a positive impact.
gonna end here with our little fun bit here by ask you what rabbit hole you've been going down. New martial arts, UFC, something like that. Anything? What do you got?
As far as rabbit hole, actually, unfortunately, it's nothing fun like those. It's been all around. Really, how do I execute all the institutional quality type portfolios in this world? And I think I'm driving my firm crazy too. Like I think engineering hates me, product hates me because I'm constantly now. By the way, one good thing about Farther is like we have a whole like which RRA can tell you that they have like tons of software engineers where you can go to them and say, hey, can I have this? And if it makes sense firm wide, they may work on it and features and so on. So I'm at a place that I have access to that. Yes, they hate me, but and I mean that jokingly. No, they're
Yeah,
great to work with, but so the whole thing is, can I
your job
finally?
security for them. Yeah.
What's that?
Your job security for them.
Right. So how can I really close this gap of finally being able to execute as closely as the institutional side in this space? And we're not there yet because there's so many factors, right? But I feel like I'm getting close, and I think once we finally bring it all together with a lot of the ideas that I have, and sort of like Florida's really stepping up to the plate and creating some really cool tech. I think that's something that's going to be really a huge differentiator. That it's going to be a beautiful story added to the rest of the firm's history.
Love it.
Yeah,
My rabbit hole's been AI video creation.
yeah. I mean,
There's like it's great. I there's a picture of me just sitting on a panel down in Austin, right? Still picture. I threw it in the AI thing and said, uh, finish this conversation in the Death Star. And it like has me stand up, walk around, and then walk into a hallway of Star Wars Death Star. And looks, I walk a little weird. It looks a little unnatural, but the rest of it is like, what? Just from one still picture.
right, right.
Yeah.
No, I mean, yeah, we could talk like that is going to be. It's interesting. Like that's, I'm sure we could talk hours about the AI and what it's done and how it's like, even little things. Yeah, I use it all the time in different functionality and different aspects. Even like, obviously, for me, like my jujitsu and the health part and optimizing that side of it, how you could really implement it into overall. Yeah. So it should be an interesting time
You
moving
still
forward.
do the jujitsu?
I do. The body is pretty wrecked, so I've had to kind of modify it a bit. I mean, I have like torn labrums in both hips and the shoulder, like bone on bone, like so. It's
Mm.
taken a beating throughout the years, but I still could kick a lot of younger guys' butt,
Yeah,
way much
mine
younger
for
than me
sure.
and bigger than me. So as long as I can still do it,
We
I'm
can go in for hip replacements together. Mine's getting there. I got like one or two more good ski seasons before I need to get the new hip.
yeah, yeah. But no, it's and that's like part of like that's always gonna be a part of me, right? I think. You're gonna have to, even if I was in the wheelchair, I still be rolling myself on the mat, and because of what it does. And going back to the fighting thing, like initially when I started, obviously I've been doing it for I don't know, like 20 years. It was different, right? The reasoning now is different, and there's an element of like Zen to it. Like, to
Mm,
be honest
yeah.
with you, it's the one time that you're in a place like you're really like you're not worried about all the things you got to do. You're not thinking about the past. You're really in the moment because somebody else is trying to take your head off. You don't have time
Yeah.
to, think about it. So
I
that's
love your Zen is grappling with another sweaty man. Yeah. I'm
yeah,
in my happy place. Yeah.
right. Yeah. Yeah, it's there's actually an interesting I'll send it to you after I'll send you there's anyhow, but depends how
I've
you
always thought you could win really easy if you just had the worst body odor, right? And then you're like, oh, I don't really want to get in there and do this grip. It's too smelly.
So what the funny thing is, and I don't know if this is appropriate to say. I'm one of those guys like if I use a public bathroom, I use like 18 rolls of paper and like using elbows. So I'm sort of that. But in that environment, it's like all that goes out the window. I don't I like
Mm.
you, another guys could be on top of you, is like his sweat is like dripping on your
You're
face,
don't yeah, you're
and that
thinking about
doesn't
how to
phase
get
me.
out. Yeah.
So I was like, how is it that I'm the guy using elbows and like versus like, and I think that's just another aspect of it. But we should get you on the match one time, Jeff.
Oh my God. Yeah. Um, against a child. I was on the airplane doing the chess on the back of the seat against Magnus and whatever the champ's name. And I was like, I won one and I won again. I'm like, man, I'm good at this. And then I look closer and it's like, do you want to play again versus Magnus as a third grader? Or do you want to play against him as a fourth grader? I'm like, oh.
Right.
And I think I made it up to fifth grade until he was beating me every time. I'm like, oh boy. Yeah. So that would be me on the mat. Like
Yeah,
maybe.
I saw that 60 Minutes documentary that came out on him. It was a couple years ago. It was fascinating. Like he had his back to like a bunch of professional chess players and he was still beating them or something. It was insane.
Yeah. Unbelievable. All right, we'll leave it there. Thanks, Kevin.
Thank you.
We'll talk to you soon. Come downtown.
Appreciate it. Bye-bye.
All right, bye.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.